Coming up on Market to Market, the president heaps praise on the American farmer. Trade barriers and breakthroughs and the jobs that go with them. And new shipping concepts collide with an aging infrastructure. Those stories and market analysis with Naomi Blohm next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, June 23 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Your weekend barbecue plans will no longer include a Brazilian beef option. USDA halted all fresh beef imports from Latin America's biggest country based on safety concerns. U.S. inspectors have blocked 11% of the product since March. Existing home sales stepped over an April decline as May rebounded 1.1%. A tight inventory has pushed the median home price to an all-time high. New home sales increased 2.9% last month on stronger gains in the South and West. Crude oil prices hit a 10-month low this week and are down 20% in 2017 as the U.S., Libya, and Nigeria have increased output. Black gold's performance is giving Wall Street traders pause for concern on the entire market, but not enough to slow the rallies as technology companies drove records set by Dow Jones and the S&P 500. Traditional energy sources like oil have competition in the marketplace from alternatives like ethanol. President Trump championed the coal industry on the trail and this week played down the reliability of wind energy at an Iowa event. Peter Tubbs reports on one of the trip's other major themes, agricultural trade.
Than ever before. Farming, which is something that is very beautiful to me. I'm not a farmer, but I'd be very happy to be one. It's a very beautiful world to me. And it's a truly noble American profession.
President Trump came to Cedar Rapids, Iowa this week, celebrating the American farmer and worker. Trump's focus was on improving outlets for domestic agricultural products.
American farmers and ranchers are the best, absolute best at what they do. And they can compete anywhere if they're given a level playing field. They're not given that level playing field because of our terrible, terrible trade deals. And we're going to start doing much better. You produce the product, but you have to work too hard and too long to make a living. We're cracking down on foreign trading abuses, making it easier to produce and grow in America, eliminating job-killing regulations all over the place. And we're training our great American workers.
Earlier this week, Market to Market spoke with former Secretary of Agriculture Tom Vilsack. In his new job advocating for American dairy products, had a front row seat for a recent trade deal.
There has been a lot of news over the past several weeks about China's finally lifting the ban on U.S. beef moving into that country. And somewhat overshadowed by that was another announcement that China made concerning U.S. dairy processors. Could you tell us a little bit about what that change was?
You know, it's interesting on the beef side. We're already selling beef into China. We just are selling it in an indirect way. Either that or the Vietnamese are eating a tremendous amount of beef per person.
The people in Hong Kong sure are eating a lot of beef as well, yes.
So, but this was on the milk side, dairy side, a big opportunity for us. And it's complicated because China came out a couple of years ago with a different set of requirements for their certification for exports. And it basically requires processing plants to be able to meet certain specifications that the Chinese have set forth. And then they need to register their plant. They need to be verified that they're meeting those specifications before they can put product into the market. There are probably over 200 facilities, 200 plants in the U.S. that have wanted to do this but have not received permission because they just simply can't get on the registration list. The reason they couldn't get on the list was because there was a lack of clarity, a lack of certainty about precisely what the process was going to be and what the requirements were. Well, this MOU that was signed this month between China and our Food and Drug Administration, the FDA, basically lays out a process by which the FDA and their Chinese counterparts will work collaboratively together to get these over 200 plants the information, the guidance, the process by which they can qualify to get on the list. And that's going to create opportunities for them to sell across the board in terms of everything from fluid milk to cheese to ingredients to whey to lactose, all across the board, all the products that we can sell. And that creates a tremendous opportunity for us in China.
We've seen Canada ruffle some feathers in the U.S. dairy industry with their new classification system and the exclusion, for intents and purposes, of ultra-filtered milk from U.S. producers.
Well, it requires, I think, the administration to take a firm stand on the way in which Canada uses its supply side and supply management program. Essentially what happens is whenever America begins to get a foothold in that Canadian market, the policy gets changed. A new classification, new category, a new standard, new specifications are developed by the Canadian government, and that results in us not being able to export as much into Canada as we would be able to. And it's also detrimental to Canadian consumers. They pay a substantially greater amount for their dairy products than they should because there just isn't competition. And it's a shell game because when we export into Canada, oftentimes what happens, it gets processed and then it gets re-exported, if you will, back into the U.S. in a value-added
We're
proposition.
shipping bulk milk into Canada,
Right.
Counts as a dairy export, and then they're shipping
Right.
processed product into the U.S., counts as an export.
And that's not the way it's supposed to work. We're supposed to ship it into the country, and it's supposed to be used in that country and used by consumers in that country. I appreciate the fact that Secretary Perdue recently met with his counterparts in Mexico and Canada. I'm sure there was a frank conversation and exchange of ideas. But at the end of the day, bottom line, we want to preserve what's working and we want to correct what isn't.
For Market to Market, I'm Peter Tubbs.
The third tropical storm of the season swung through the southeast this week, impacting millions by dropping rain and spawning tornadoes. Anywhere from 2 to 10 inches of rain fell along the Gulf Coast. River traffic was slowed as barges parked upstream to ride out the storm. Cindy didn't cause major damage to the lock and dams, but rather decades of navigation have done that. John Torpy brings us our cover story as a dilapidated system tries to reinvent itself at the same time.
For industries making a home along one of the nation's inland waterways, the search for streamlined operations can be hard to find on such an unpredictable road. However, an idea putting two transportation technologies together is gathering attention. The new practice, dubbed container on barge, puts two transportation streams together in an effort to move goods more efficiently and cost-effectively from place to place.
Is container and barge in our future? It would definitely relieve some of the strain on our transportation system if those goods that come in from overseas could, come upriver to Kansas City, to Chicago, to St. Paul, to Pittsburgh.
Trucking companies have moved goods from dock to warehouse, making sure to minimize costs by trying to never move an empty load. Getting commodities downriver by barge to southern ports for global export is a mainstay in the nation's business mix. However, for years, empty barges made a return trip high in the water. Starting in 2007, inland waterway organizations started experimenting with maximizing the cost of a return load by putting containers on barges traveling to ports upriver.
So we have our goods coming in that way that are currently on road or rail. They come up the river, and then outbound we have grains, we have some of the exports. It would be a tremendous improvement, and in benefit to the, our economy and our environment, because we've taken, goods to the most economic, efficient mode of transportation.
The Inland Ports, Rivers, and Terminals Association touts an environmental benefit to this new navigation technique. If fully implemented, officials say container-on-barge shipping has the potential to reduce greenhouse gas emissions by reducing traffic on the nation's interstate system by as much as 875 semi-trucks per lane per day. Container-on-barge carriage has received a warm reception in the Port of New Orleans. Grants, subsidies, and Department of Transportation funds have flowed into one of the busiest ports in the country to support startup operations for the young shipping method.
The Port of New Orleans is doing well. We are an unusual port in that we're not married to one commodity or one type of shipping. So we have containers, we have break bulk, we have some bulk commodities as well. We're a multi-purpose landlord port, as we like to say. And for the last year or so, business has been picking up. We've seen increases in our container volumes. We've seen increases in our imported break bulk cargoes. So overall, it's pretty good.
Both the ports of New Orleans and Greater Baton Rouge were deemed attractive testing grounds for the innovative shipping method due to the diverse list of commodities that move through each day. Officials at both ports think the new style of moving goods will be attractive to business owners searching for new ways to streamline the cost of doing business.
A lot of major retailers and a lot of major shippers are very concerned about their environmental impact, and barge transportation uses a lot less fuel. It keeps trucks off the highway. There's no idling time, so to speak, so it's much more environmentally friendly and leaves a smaller carbon footprint.
While moving more goods on the river and less over the road is attractive to some businesses, there are others who point out a less than predictable timetable as a major deterrent for container-on-barge shipping. A 15-tow barge navigating down the Mississippi River from the Midwest can expect the trip to last around 13 days. Once the goods are loaded onto ships, up to 30 additional days are added to the schedule for the goods to reach their global destination, bringing the travel time to over 40 days. If the same products are loaded on a train and sent to the West Coast for export, the trip to the port can take up to 6 days, greatly reducing travel time and improving efficiency for shippers.
Containerized shipping for agriculture, it's something that's growing. The inland waterway system is something that should be utilized more. It's not a congested system, but the problem is it's not a reliable system. Barge transportation, it's good at moving heavy product long distances at an economical price point, but it's not very good at quick turnaround, at transit times, at having a real rapid transit time.
The experiment has gained some traction. As of 2015, the U.S. Department of Agriculture calculated 8% of all waterborne grain exports were shipped in containers. Another aspect holding back the practice from becoming more common is the drag put on shipping due to an aging infrastructure along the nation's inland waterways. For several years, environmental groups, the navigation industry, and agriculture advocacy groups have been raising red flags to Congress over the dilapidated state of the nation's lock and dam system. The unlikely bedfellows hope to get politicians inside the Beltway to shake loose appropriate funding before a catastrophic failure occurs with a devastating economic outcome.
For agriculture and other stakeholder groups, we don't think it's an effective strategy to wait for a catastrophe and then pounce upon that to try to get something done. I think we can do a good job of portraying the importance of it, but then also conveying what the consequences would be if we still have this inaction from Washington, D.C.
While the details are sorted out on infrastructure improvements, shippers and retailers wait for the right confluence of cash and containers before moving further ahead with a new shipping strategy. For Market to Market, I'm John Torpy.
Next, the Market to Market Report.
Rain and cooler temperatures took away consternation over weather, and increased competition from South America hammered much of the commodity market. For the week, September wheat fell 8 cents and the nearby corn contract plummeted 27 cents. Technical selling coupled with rain fed the bears again in the soy complex as the July contract tumbled 35 cents. July meal dropped $7.30 per ton. In the softs, December cotton compacted $2.34 per hundredweight. Over in the dairy parlor, July Class 3 milk futures soured 39 cents. The livestock sector slumped again as the August cattle contract fell $2.90 and nearby feeders fell $2.93. The August lean hog contract slipped 48 cents lower. In the currency markets, the U.S. dollar index increased 7 points. Crude oil dropped $1.96 per barrel. COMEX gold declined a dime per ounce. And the Goldman Sachs Commodity Index retreated 10.5 basis points to finish the week at 353.5. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Thank you.
In case you want to go over things again, you can listen to our Market Analysis and Market Plus podcasts anytime online at iptv.org/MTOM. Naomi, we had quite a story going in the wheat markets here for the past 3 weeks. This week, Chicago wheat seemed to take a step back. Are the fundamentals supporting the Minneapolis spring wheat contract changing?
The Minneapolis spring wheat contract is still a very friendly story, without question. The more I talk to producers in that area, the worse it's sounding and the worse it's getting. The Minneapolis July contract was able to get real close to the 675 level today and just has such fire underneath it because there is not a crop there. How high could it go? It's too early to really even speculate just because we're trying to really understand the graphs of what's going on and how extensive that damage is between North Dakota crop and the South Dakota crop. But it's a very legitimate market. Going over to the Chicago market and the Kansas wheat market, you know, they did have a nice push higher following that Minneapolis spring wheat market higher, but they are running out of news in and of themselves to justify it to go much higher. And those prices hit some technical resistance levels on charts, and I wouldn't be surprised if we see that market set back just a little bit because on their own they don't fundamentally have the reasons to rally any higher. Okay. But at the same time, it's the wheat market leading all commodities.
Yes.
And who would have thought?
Well, and as we look at the Chicago and Kansas City contracts, harvest is getting underway, hampered in some spots by rain. Have you heard yield reports so far?
I've heard mixed results on reports, some saying trend line, some pleasantly pleased, some saying, oh, it's not there. So it's really all over the place, and we're trying to get a better handle on that too. On Monday afternoon will be the most recent crop progress update on what's been harvested. I think we'll start to get some additional numbers soon.
Okay. Well, now I want to take a look at the corn market.
Yeah.
I don't want to take a look at the corn market here in Iowa. This has been a rough week for producers as we dropped 26 cents on the nearby contract, 26 cents on the December contract. Old crop corn, producers still have a lot in the bins. After a drop like this, folks are getting a little nervous. How do you handle what you've got in storage?
Breathe.
Okay.
Right now. What the market did today and into this week, I think, was primarily two things. It rained. So that was the reason for the setback. Going into the weekend last weekend, it was a situation where if it wouldn't have rained, the market absolutely would have gone another 15 to 25 cents higher without question. But it rained. I'm so thankful I called my clients and did a voice broadcast and said, it looks good. It looks like it's going to rally, but let's make sure we're selling old crop today. And hey, look, the new crop price is at 405. Let's make sure we're making some cash sales also. But I too thought it was going to be able to continue higher, but again, it rained. And then you have the situation where we just didn't have enough immediate friendly news to get the funds to go from all those short contracts that they had to neutral. They didn't have enough bite to go long in the market. So they're like, let's go back and be sellers again. So where the market price went today, July options expired. There was the most open interest at the 360 strike price level, and that's exactly where that contract went down and hunkered down at to today. The new crop contract has support at the 375 level. Let's get through the weekend. This is a big support level that has held since November. We are back at those same levels. Okay. So we need to have some news pickup, obviously, in the form of weather. Perhaps next Friday's quarterly stocks report and the planting acres report will give us a reason to have a push higher again.
Do you have an estimate in your head of what to expect on that June 30th report?
I don't, because it never really matters. They always give us something that you're not expecting anyway, and it's always a 50-50 wild card what it's going to be.
Okay.
So I'm ready for anything, but I would say any recovery bounces that we get here, you got to work on selling it, just because for the old crop fundamentals, they're not going to have the reasons that we were looking for to get that market to move higher. But here's another thing. The crop is rated 67% good to excellent. And if you look back at history, for that same week in history when the crop has been rated between 65 to 69% good to excellent, yield at best in those years was trend line. Okay. And a lot of those years they were below trend line. So you can't write this crop off to say it's going to be this amazing, amazing crop, because it's not.
Well, now that leads us right into our question from a Twitter follower. This is from Jeremy in Lanark, Illinois, and we encourage all of you to send in questions on Twitter and on Facebook. Just search for Market to Market. He's on Twitter at jflickema. He's asking, the market is telling us to prove it needs to rally with a production problem. What should farmers do, new crop bushels, that need to move in the fall if we don't get a rally, or if that last Friday's rally was it?
Yeah, well, so here's the deal, though. I don't think that the market is going to have a tremendous sell-off, because even if you have the trend line yields, ending stocks come in at 2.0 billion bushels, which is less than what we've got now. And with this wheat situation, hey, we got to fight for acres next year, and maybe the Dakotas are going to start planting wheat again. You can't see this market sell off too much. But at the same time, we don't have the immediate reasons to get us to go higher like we thought, unless the water stops and it is hot and dry in July. And with as staggered as this crop is for growth, pollination is going to be over the course of a few weeks, and it's going to be later than normal. Yeah. So the whole weather scenario is going to be watching the end of July this year, and there still is some time yet for a bump higher. So I'm not throwing in the towel yet, but at the same time, those bigger picture reasons for a huge rally have diminished. So you've got to be plugging away on sales every time this market is moving a little bit higher. Okay, let's take a look at the soybean market. Old crop beans hugging that $9 mark. Do we break through it in this next week? I don't think so, because again, that was part of that option expiration thing, and that's where all the open interest was. So that was the point of contention to be watching. The fundamentals are still so friendly for soybeans. It's too early to just sell everything off lower here. Okay. So if you had any beans to sell yet, or if you're thinking about forward contracting, I would be patient. I think we're going to get some sort of a summer scare, because we still have to figure out what is actually planted out there, and the growth is behind on it. And when you have 20% of the production between South Dakota, North Dakota, and Indiana, that is not good. What are the odds of having above trendline yields? So again, I think be patient, have plan B ready to go just in case, because you never know. But I would just be patient. I think you're getting a bump. Don't be rushing into it. Now, Naomi, as our Wisconsinite, I want to talk to you about the dairy markets. Yeah. Broke back up above $16 here on the nearby Class 3 milk contract. Where do we go? Do we get a shot at 17 this year? Yeah, I think so. What happened, we were up at the 17 levels, and then cheddar cheese prices fell. And so it always comes back to pretty much the cheese market for milk prices right now. And for the month of June so far, cheddar cheese prices have not had any really substantial upward momentum. So the milk prices have set back lower. We had a production report come out for milk, and production is up 1.8%. And so it's never been a supply problem. It's just, thankfully, our demand overall is good. I don't see milk falling substantially lower. Okay. Demand is really good, but at the same time, we don't have a reason to get really above 17 either. Gotcha. So looking for a big sideways trading range. Throw some cheddar cheese on those hamburgers at the 4th of July. And put it in your eggs and put it on everything. Yes, yes, it makes everything delicious. Now, as we're talking hamburgers, the cattle market continues that huge downward break that we've been seeing. Ended the week at 115 on the nearby. Where does this thing stop? At the 110 level for the August contract. Okay. So obviously the August contract for the fat cattle got up to 127. Too high, don't have enough news to get it to go any higher than that. 117 was a major support level, and that fell. So with that breaking, and with the cattle on feed report today being a little bit on the negative side. Yeah, could you run the numbers for us? 103 was the on feed number, and then the placement marketing numbers just came in a little bit higher than what they were expecting as well. So that's going to leave the market with a little bit of a negative feeling. But the cold storage report this week showed that beef in the freezers was down 10% from last month. It is a demand-led market, and even though the deferred contracts are saying, well, we're expecting this huge jump for third quarter of an additional 415 million pounds, it's priced in, and demand is good. So I'm not giving up on cattle, saying that it's never going to come back or anything like that, because with the Dakotas, some of the producers there are saying we're going to have to get rid of our herds because there's nothing to feed them. Yep. It's a big deal. Liquidation, you bet. That's a huge deal. So we might see it technically slide a little lower, but it'll find good support there. All right. And feeder cattle, just going to follow along. I'm surprised we didn't get more of a response with the 26 drop in corn prices. Yeah, exactly. You know, I think with the feeders, every time they get up to the 160 level, It's just too expensive. And then they back down to the 140, and then interest comes up again. So same thing, I think it'll come back.
All right. Yeah. Lean hogs, Naomi, we're looking at new plants coming online. Production continues to grow. How does demand stack up in the lean hog market?
Surprisingly well. The cutout values were insane, and that's what pushed the front month contracts higher. So high short-term demand. The pork bellies in the freezers are down substantially from year-ago levels.
Really?
Yeah, bacon. It's always about the bacon.
Yeah, especially this time of year.
Yeah, exactly. And we haven't even gotten into the bigger bacon season with BLTs and everything like that. So going forward, the deferred contracts have already priced in the increase of production, and that's why they're substantially at lower levels. So I don't think you see the hog market fall apart or anything like that. We have to, though, make sure that the demand keeps up, because that's the only reason that the front month contracts have been as high as they are.
Can front month take a run at $90, Naomi? I mean, we're looking at it. Is that in the cards at all?
If you eat more bacon, maybe so.
And on the world of exports, we know exports led the pork market. Can they keep running?
It's always been a number where the pork exports go between 20 to 25%. It seems to be a constant thing. When we are exporting at 25%, we see obviously the prices get a little bit better. Exports have been down smidge, but they're still over the 20% level. So I think that our demand for our product is there globally. I would expect it to continue.
All right. Well, Naomi Blohm, thank you so much for taking the time to talk to us.
Yeah.
That wraps up the broadcast portion of Market to Market. However, Naomi and I will keep the conversation going, including answering more of your questions during Market Plus, which is available in podcast and video form on our website. We've also launched our own YouTube channel. Check us out at youtube.com/market-to-market and subscribe today. You'll get notified when Market Plus and our feature stories are posted. And join us again next week when we explore how farmers are rebounding from a double whammy in the Palmetto State. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.